So I am Tim Quast, and it is March 2025, and this is the Edge Live demo and discussion, we call it. And with me is Brian Wilson, market strategist, and I'm going to, now that my mic is working, so it turned out to be a software conflict, not a mic issue, and I got that resolved. I will take the first half and then hand off the baton to Brian for the better half of this discussion. I've got a number of things to cover. I will tell, first off, just a quick reminder, I will be gone because I'm bone white and look like a cadaver. I'm leaving snow country to go sail in the Caribbean, as is our custom. We go do this, as the ski season comes to an end. So I will be out the next 2 weeks back. I will be back penning the Market Desk Note April 7th. We get back the night of the 6th. So I will be back then, and you will, in the meantime, be in the very good hands of Brian Wilson, Henry Howard. Actually, one of our team from Modern IR, Perry Gruber, is on this discussion today too, who knows a lot about market structure too. So anyway, have fun without me, and you will, right? It'll be a nice break from me. I'm looking forward to it. It'll it's always fun. We've got a good group of friends, and it's fun to go out there and sail for a little bit. Now, number 2 on my list, trading volatility. I want to talk about this a little bit because we've had this really great period where we can do this, and I'm going to share my screen in just a moment because I want to show you a couple of things. But I will continue to explain to the best, to me, the data have been just very helpful in telling us what to do. And you can, you will see it in your own, probably anyway, performance. Hang on, let me see if I can, there we go. 1 second, I had probably just a user error. Okay. I will share this and I'm sharing this just to confirm, I do the same stuff. Edge is the only tool I use to decide what I'm going to do. And so this, I'm just showing, I told you I added money to my trading account because I got the green light from my wife, Karen, who said, okay, well, you haven't lost it all, so I guess you can put some more in there. So, and it's, it's been interesting to, now it's bigger trades, different set of things to think about. But I did the same thing you do. And I'm sure that there are a number of you that are trading much larger numbers than I do. I traded $50,000 for quite a long time to aim small, miss small. You learn how to do things. Basically summer of last year through the end of the year, I was really focused on learning some things. How do you trade volatility based on the, because we look at demand, supply, and volatility. Okay, how does that all work? Testing stops and limits. And so I was willing to take some risk, but this is just the look here month to date. And it tells you the 3 things that have worked well and where I lost money. I lost money on SPXL. Actually, that worked really well today, and I'll talk about that. I will only trade these weird instruments they're synthetic exchange traded funds. They're risky instruments. Am I a fan of these? Only to the degree that they permit us to profit on volatility when the data tell us to do so. But you can see I lost money on SPG, not much. That's my percentage. Losses. Lost a little on CAH. It was up, and then they're out of low volatility because that was the thing to trade. And then this has produced a, more than 15% return in that blue line, very short-term return here, where the market has really struggled. And this is not self-congratulatory. This is about how the data work. And I want to go to, they do work. There's no question about that the data are very effective in showing you what to do. Let me get to the right screen. And this is what I want to talk about, trading volatility. One of the questions I was on with Dennis, Dick, and Joel Elconin, who they've got a new thing, Traders Network, StockTradersNetwork.com. And they do these discussions, kind of midday things. And and I was on with them. And one of the questions from the audience there was, well, if you buy these leveraged instruments late in the day, then you run the risk, they're overnight. I've talked about that here too, of big losses. Well, always hedge yourself. The point of hedges is to mitigate the unknown. I don't generally, if it's a momentum market, whole different deal. If we can look at the data and go, wow, money is pounding into momentum instruments, it's a different kind of market. It's not the kind of market we're in, and we will always know what kind of market we're in by looking at the momentum portfolio, the low volatility portfolio, broad market demand and supply, and of course you can look across your dashboard and you're going to see it. When all the lines are moving up and the supply line is moving down, you get big divergences. Momentum market, we're going to trade momentum. And as that deteriorates, then maybe it's balanced, and then it deteriorates further, low volatility. And from a trading standpoint, when volatility goes up, your longer term position should be in places that shelter you from volatility, low volatility. Look at Aon. Yeah, I have got Accenture up here because I was looking at this earlier. But if Aon, I think, is still in the low volatility portfolio. It's got volatility of about 1.7% versus 2.8% in the S&P 500. And so it spends a lot of time at 5. It's not going to be perfect, but it has outperformed the market. The supply side continues to fall. That's because people will cluster in this sort of thing to protect themselves from the volatility of the S&P 500 when it becomes volatile. If it's 2.8% volatile, then you're going to go look for things as a big money manager that have less volatility in them. Then that trade becomes crowded. But we're going to see those kinds of things. So back to using these leveraged instruments. When you buy them in the last 10 minutes, ish, because that's where the reference price is. The price that the folks tracking the S&P, I'm just going to oversimplify, need is in the last 10 minutes. It will ultimately be the last price of the day, which is the reference price. Well, it's going to be very tight in there because there's a lot of order flow to match up at derivations of midpoint. And so the last 10 minutes are going to give us that. So if SPXU, so short, the S&P 500, leverage short, SPXL, leverage long, then I mix in volatility, UVIX, SVOL, for volatility. Again, I'm not making recommendations. They're risky instruments, but I want to explain how this works so well during these periods. They all are predicated on swaps, which will use the reference price. All right, so you're parked in it overnight and you're thinking, oh, I'm at big risk. No, the constitution of the derivatives that will deliver the return that instrument is designed to deliver are predicated on the same thing. So as long as you're protected, if I buy a long bet, whether I bias it one direction or not will always come back to broad sentiment. I'll show you that in just a moment. I'm not concerned about what's going to happen overnight. In fact, most of the time, it's where my return comes from. So there isn't that, go another day. So if you hold that through another day, now there's a whole different swap constituting the expected return. And, that will reflect different supply and demand in the derivatives, whatever they may be. There will be a basket. They could be options of underlying stocks. They're going to be contracts for difference, but a bank is going to supply that, and the bank is going to constitute them with something. And so as those change every day, then your risk increases. So they're not designed for long periods of time. Now here's how to know what to do. And I told Dennis and Joel yesterday, said looking at this data through yesterday. So this would be, the data that we would have had would have been here, right in line with VIX expirations on the 18th. And I said, if you look at this data, which direction will the bets be on the Fed meeting? Well, and those things matter because people reconstitute their risk management schemes based on what the Fed says and does. I don't like that either. I don't think a central bank should be allocating capital and labor, but whatever. It's, it is what it is. I said, this would tell us that the bias will be long, but it will be a very short-term event. How would we know? Because whenever demand is below the green line, the market always delivers upside. What determines the length of time is supply. And so supply is rising. So if you're betting on which direction things go with the Fed's decision at 2 p.m. yesterday, you would bias it long, but hedge it a little short. So, like a 2-to-1. And that proved spot on. And I'm not making that up. I'm not guessing. I'm looking at the demand supply equation, and statistically, at the green line, it's likely to go up. The fact that supply is skyrocketing means these trades are very, very short, right? So today, I didn't hold those positions overnight. I did hold a short bet, just short hedge. It just doesn't move much. And then I bought a long SPXL early, boom, right off the bat, and sold it before 11:30 a.m. Eastern time. Things change there. And now the market's down. This is my point, that these conditions are very predictable. They're not perfect, and you can't always get the day right. But the reason we're doing these things and producing returns is you can look at the data and go, well, if it's up, it's not going to last. Take your gains. And this is going to put downside pressure. If the market's down today, very likely that the same thing could happen tomorrow because the conditions creating volatility have not been resolved. So, questions or comments about that before I finish with my last point, and then Brian and I can talk about what's next together. If you have any observations, holler. Okay. Then my final thing is just to give you an update on the model portfolio. I said what we're going to do is put a model portfolio at edge so that you can trade short term. Look, it produces massively greater returns, but it comes with risk, and it's very difficult to do every day what the data say. If you the data that we ran, I think it was 2023 data that I had Nate do. I said, okay, let's run a model using the momentum portfolio where if we're down more than half of the volatility, we're stopped out, and at 2% we take gains, and run it for the entire year. Well, what did we get? Well, we got 229 trading days, meaning the momentum portfolio gave us choices 229 days out of 253, I think it was, for 2023. So whatever that math is, call it 85%, 87% of the time, there are going to be choices. And we were stopped out 32% of the time, and we were limited out 68% of the time, and it produced a net return of 1.1%. It's a model, so it's in a perfect vacuum. It's a bubble world, but that's an extraordinary amount of return, right? If you could do that. So we have now run all we did running the model portfolios from 2020 through 2024 and now year to date 2025 was to say we're going to run a momentum, a low volatility, and a balanced, a combination of those. When momentum performs, we own momentum, and we will use demand and supply and volatility to tell us to look at it, but the portfolio will tell us when it stops performing, then you shift to balanced. When that doesn't perform, you shift to low volatility. That's what we did. And there were times when momentum was the only thing to do all the way through the year. So then we compiled the results, and the model runs against SPY. So and we didn't have to make that up. It takes literally a minute using the systems we've built to run these performance models. Doesn't take a lot, and it calculates. It will give us the performance. It gives us the portfolio. What do you buy? What do you sell? If you're sitting on cash, what happens with that? It just does it every day. Here's your portfolio. If you start with $10,000, here's your entry price, and when the price close, the amount you buy, the number of shares, and then it tracks performance, right? So that's all it's doing. And over that period of time, if you just took the pre-risk adjusted return, it produced 104% return from 20 to 25 versus 65% in the S&P 5. By the way, if the NASDAQ is up 15% from where it was January of 2022. Go look at SPY is. SPY is up 15% from where it was in January of 2022. It's a 5% per year return. It really matters when you need your money. So then you adjust it. To create a Sharpe ratio, you're going to take the risk-free rate of return. What if you just put it in a bank account? And then you back that out and you calculate what's called the Sharpe ratio by taking your risk-adjusted return and dividing it by standard deviation over that period of time. And it produced an 85% risk-adjusted return with a Sharpe ratio vastly superior to SPY. And the point out of this is that math works. It's not, some marvelous thing, but we're not going to put the portfolio on there without backing data. We'll get it vetted, and once I'm comfortable, anybody who wants to look at it and vet it can do it. But it just demonstrates the significance and the importance of market structure. The mathematics, the behaviors, the regulations of the market play a very big role in outcomes. And so, we want to make sure that we're using those. So I'm happy with that. I wanted to make sure that we had, the data before we just put this portfolio up. Here it is with no backing data. We wanted to make sure we've been doing this, but I wanted it to be very systematic. So, okay,
Tim,
I will stop sharing.
Couple questions here.
Yeah.
One question that came in on the chat is, how many names were you trading at a time in that portfolio?
So we set a target of 35 in the portfolio, and a baseline, like there have to be at least 5 available before the machine will make a decision. By the way, in 2022, it could not find 5. And I mentioned this before. In Momentum, you couldn't find 5 till July. Running low volatility, which we did, we ran them all. You just run them and see which thing, as I said, you run them and say which thing, if you're using these things, which thing would you use? And low volatility did not find a basket until March 3rd, which was helpful. I mean, if you're sitting in cash, it's how you outperform under those conditions, but that's what we aim for. So 35, certain level of replacement, baseline to build the portfolio to that level. And you think, well, surely you would have a bigger portfolio. Give it a try. This is the problem for big institutional investors. It's very, very difficult to build a portfolio with 100 components. It's why all of I have read hundreds of prospectuses, and they all use statistical sampling because there aren't enough equities available that will deliver the criteria that you're looking for consistently. Now, you're going to have to true up periodically because those are regulations, but believe it or not, under the Investment Company Act of 1940, you don't have to true up your tracking versus an index till 65 days after the end of the quarter. I mean, you have to report your positions in 13Fs as an investor 45 days after the end of the quarter. We've long lobbied for every month, report your positions. Why wouldn't you? But it tells you how difficult it is to do that. And it's extremely difficult to beat the market. That I didn't know what the data would be. Almost no one beats the market. If you look at large cap, because we're only using large cap, Morningstar puts out data called the Passive Active Barometer twice a year, and they track this. 95% of stock pickers, the last 20 years, it's actually worse in growth. If you just large cap growth, 98% of stock pickers did not beat the benchmark. In large cap value, 95% of them did not beat the benchmark over the 20-year period. Most of those are gone. 70% of stock pickers have either merged funds in those categories, because why would you pick stocks in large cap? Buy SPY. And it's demonstrated here. SPY, it's almost impossible to beat it, but we did. Right? You could beat it and produce a better Sharpe ratio by using market structure, by paying attention to demand and supply. It matters.
Tim, you mentioned that you would trade from one to another when conditions kind of stalled out. What did that look like in the portfolio? Was it like over a week's period of time? What did stalling out look like?
And the only points at which we made those adjustments were either options expirations or month ends. That's it. And because again, those are, I wrote the Modern IR blog about that this week called The Pattern. It's remarkable how the whole market works that way. So again, if we're running the portfolio, those three portfolios, and the momentum portfolio stops outperforming at options expirations, we shift to balanced, a blend of value and growth. And it's the criteria. Are they spending, are they 8 to 10 with rising demand? Brian, I'm chewing up your time here. With supply falling. Or are they 5s with diminishing supply and that, or are they just 5s with demand? There's more to it, but that's how we ran it. And you look at the demand supply fluctuations, they occur there. Go back to 2022, really quick comment here. Same period of time we're in now, options expirations. We had a rough beginning to the year in 2022. Then at March expirations, we were off to the races for a short period of time, right into the end of the month. Then we were down from there to June expirations. Then we recovered into August expirations. Then we were down into October expirations, and the bear market ended. Why do they turn at derivatives expirations all the time? Because everybody depends on them. Big institutions are doing buy right strategies. All those index funds and ETFs have to balance out their portfolios with baskets of options. Like if I'm underweight this thing and overweight that thing, I buy calls on this and I sell puts on that in a basket. And you say, well, they can't do that. Well, sure they can. 10% of your assets under the Investment Company Act of 1940 can be used for those purposes. It's why I talked to the SIBO yesterday. The SIBO created this index product in 2014 for those purposes. So we used that. That's how we did it. But demand and supply really correlated to those things.
Mm-hmm.
Yep.
That's good. That's good.
Okay, over to you. I'm out.
Good to see everyone again. We always appreciate spending time with you guys. Great. There's always terrific questions that come in. This is Ireland, by the way. Doesn't that look gorgeous? Like makes me want to go visit. I wanted to talk at the beginning of, and I'll call it a market in transition, and I'll kind of point out just a few points here. Kind of go through a few of the portfolios. Starting off a market in transition is just our momentum and low volatility portfolios. I think I have data going back maybe a year and a half, 2 years. I was looking at normal momentum names. It's usually about 10 names on any given day. Low volatility is typically about 15. As you can see, we're below that number right now. I think it was yesterday or the day before we had 0 momentum names. So it's just a transitional time at this particular time. Those who have tracked on these calls for a while are familiar that I have 2 different short portfolios. One is my friend Barry and one is mine. I have not tracked this data quite as long as the momentum and low volatility, but normally Barry's is up around 15 names a day. Mine's north of 20. You can see both of those are lower. So you have a market environment right now that you don't have a lot of names to choose from, but it's also at the same time, it's a hard market to short right now. It's a weird market, right? We're going through a transitional time. Let me take you back one week ago today. This is a report that we'll use for our investor relations clients. And what I want to show you is what volatility was at that time. It was crazy. Crazy high. 5-day intraday volatility was 3.4%. It was 48% greater than 200-day norms. Now you fast forward to right now, and what we're tracking is a very different ballgame. Look at intraday volatility down to 2.5%. versus norms of 2.3%. What was I trading a week ago? And Tim and I vary just a little bit with this. They're basically the same product, but I'll usually trade UVXY. I'm just more familiar with that product.
By
But
the
I was
way,
trading,
one
yeah,
quick interjection. I've asked our engineers to add that data to the Edge platform. So
perfect.
it's in the process
Yep,
now. Just
yep. So, just as a way of thinking through, what do you trade at different times? Well, a week ago, I was trading UVXY, betting on further volatility in the market. You could see it. It was 48% greater at that time. I had placed a trade in SPXU. Both of those trades worked. As the market started to become less volatile, I switched directions. I traded into SVXY, very similar to what Tim likes with SVOL. I traded in and out of that a couple of days ago. I traded into it again yesterday, and I mentioned that in today's note. Why am I in that trade right now? Well, look at the volatility. It's disappeared from the market. It's reverting back to its norms. But it is a market in transition right now. Let's see. And part of this transitional period is, and Tim already mentioned this, with some of my clients on the IR side today, I'm calling it a battle. Why am I calling it a battle? Because of this right here. We have oversold sentiment that is coming right up against short volume that is increasing. And as Tim mentioned, you tend to get gains, but they tend to be very short term in nature in this environment. It's a market in transition, and we'll talk about what's ahead here in just a moment. I did want to talk for a moment about what we're seeing so far this year. And if you've been on these calls over the course of the last few months, you know that we talked about the potential for a bear market in the beginning of this year. No, I shouldn't say a bear market, but a market that would come into a little bit of difficulty. Well, so far that's been the case. I wanted to back up the sentiment and look for a moment to show you what was happening at the end of last year versus what's happening right now. So pay attention for a moment just at the periods of time when we're moving above the red line and what was happening there. It was happening on about a monthly basis. So end of July, move above the red line. End of August, move above the red line. End of September, move above the red line. End of October, move above the red line. You catch a drift here. Expirations about 3 weeks later above the red line. And then the early part of December, once again above the red line. It was about 3 or 4 weeks apart, the normal cycle of the market where it would become stretched, it would move lower, it would become stretched. That supported advances in the market. Guess what happened in December? We lost that normal rhythm. We moved lower than we had. That was a couple years, wasn't it, Tim? We had gone, it had been a big stretch of time since we had gone that low. But look how far apart it is. So if you
2022
go,
had
yeah,
not gone that low since 2022. Well,
yep,
it's
yep,
telling.
exactly. And look at this stretch here. We moved from December all the way to the end of January. So we go essentially two full months, and then look what's happened again now. We've gone another 2 full months, obviously nowhere near the red line at this particular time. So conditions have definitely changed here over the last few months. We're not getting that normal sentiment rhythm that we had the latter part of last year. Look at what's happened in terms of short volume as well. Short volumes had moved very low ahead of the election. Look at what's happened really starting at the beginning of January. We moved above the trend line. We've not gone below it from that point going forward. So we have sentiment that's not as strong, just talking in general terms here. We have short volume that is generally staying above trend. Not great conditions, from a broad market perspective. Tim, I'll talk for a second about what I think is ahead, and then feel free to interject. I'll bring this look back to a 6-month look for a second. As we look at where we are, obviously we've talked about this. Oversold conditions, higher short volumes. What happens as we come out of expirations this week and the focus shifts to the April series next week? Do short volumes continue to move higher? I don't know right now. But if they do, that's to me, that's going to really squash any market rallies. Or do we get an environment where shorts start to get covered coming out of expirations? If that occurs and the market's oversold, well, maybe we could get a little bit of a lift, for a week or so. I don't know. These rallies tend to be very short term in nature right now, and just be aware of that. If you're looking for these broad market positions, consider them maybe a week at a time or so. Much longer than that, and anymore, the conditions are really changing rapidly. I mentioned the short covering. Will we potentially have short covering? I think we have some work to do, though. You look at mega cap right now, it's bottomed, but it's still really weak, right? Sentiment is only 3.7. Short volumes have been trending higher. We look at big tech. It's very similar. We bottomed. We're getting a little bit of relief, but sentiment's only 3.1, and that short volume trend is also moving higher. So we'll have to pay careful attention coming out of options expirations, but I'll classify it as a market where we have some work that we need to do right now.
Yeah, I don't have any different view. It's the dip below the green line is an entry point, but with rising supply, they're very short term. Today is a great microcosm where a long trade worked for half the day and a short trade worked for half the day, and it's because of those conflicting threads. And unless and until they resolve, and we just watch it every day. I always say we'll just look at broad sentiment every day. Always beware of context. Look for divergences. If there aren't many divergences, look at volatility. Can we trade volatility? Keep in mind, this is a fraught week in which there will be no manifestation of rational thought. Everything that occurs this week will be about people's derivatives positions, index rebalances on Friday, with tomorrow, all of the stuff that's expiring and resetting, and everybody who's got some vested interest in that. Their banks and their customers are transferring risk. They find, well, who wants to take it and who wants to offload it, and then can we mash these parties up and hedge it? And that's what everybody does. So you can see it in the data. You can see which direction things go. I've used Aon as an example. You look at the data, and passive money has been effectively doing a buy right strategy on it, because the short volume in Aon has dropped 16% in a week. Well, that's what that banks hedge in the direction of demand. That's what they're going to do. Right? If everybody's on one side of the boat, then the support is going to be to offset that a little bit. That's how it works. And you say, well, why wouldn't they short it? Well, no, then you're at risk. If you cover, you could you don't have naked exposure to the risk transfer, and maybe you can lend it out to someone. So that's what they're doing. And it's, all of those things fit into the mechanic. You don't have to bog down in the details. We're going to see it all in demand and supply. Demand and supply reflect all known motivations and even the unknown ones. And so you can tell it's a mixed bag right now. Demand appears to be bottoming, but with supply rising, what happens if we don't get back to 5? Well, and probably not good. Now, we could do the very same thing that happened in 2022, which is a great run into the end of the quarter. I'm not saying that's going to happen. In 2022, we did not have this rising supply side that you see now. So we'll just watch it every day, and you just take what it gives. It will give you something to do all the time. When context is dangerous, just beware of that. And if you're risk averse, look, I'm pretty risk averse. I immediately took gains on my long side today, and I even closed out my short because if I can't watch something, I was skiing. Then Karen and I went up Black Mirror, which is behind me. It's a wonderful. It's our last time we're going to be able to do that this season, and I don't want to be worrying. I'm just happy to take the gain. And every day there will be something else that we can consider. That's the best way to think about it. That's all I've got. Any words of wisdom? Dan, you look contemplative there, reflective. How are things in Florida? I hope they're well. No pressure.
Okay. trying to figure out my instructions here. Things are sunny and warm.
Yep, as we would expect. Good.
Yeah.
That's a harbinger for where I'm headed, which is further east of you.
Yeah, I'm not quite where you're going, but have a good time.
Thank you. Thank you. Will do. All right. Well, we'll let you go then. We've been keeping you along. We'll cede some time back. And I know Brian will look forward to seeing you next week, and he may have a sidekick as well. And I will see you all in a couple of weeks. Take gains, not chances. See you when I'm back.